Hi, this is Richard Vague with Tychos. Evergrande, once one of China's largest property developers, has been ordered by a Hong Kong court to liquidate. The news comes as China continues to attempt to rein in a struggling real estate market following one of the largest real estate booms in history. Just prior to the pandemic, Evergrande was one of a few large property developers leading the charge in China's real estate sector with a net worth of over $51 billion. However, in just 2 short years, they managed to become one of the most overly leveraged companies in the world, with debts and other liabilities as high as $400 billion, bringing their net worth down to an unsightly negative $73 billion in September of 2021. By December of that year, Evergrande had officially defaulted on their debt and become the first domino to fall in China's floundering real estate sector. Since that first default, Evergrande has been working with its creditors to restructure its massive debt load to stave off that liquidation. However, these restructuring attempts appear to have been futile, and even though investors felt and claimed they were too big to fail, last Monday a Hong Kong High Court ordered its liquidation. What does this mean for China's economy? One key thing to watch is how this liquidation will be managed. If forced to sell excess housing inventory too quickly, the sale prices realized could be very low, exposing the diminished value of the real estate held by millions of China's citizens and sparking a panic, frankly. Therefore, look for China to manage this liquidation carefully in spite of or against the court's rulings, and employ creative financing and accounting strategies, very much as it did with bad banks in a similar crisis in the early 2000s. This has been a slow-moving and foreseeable issue in China. Their economy for years has relied on the rapid expansion of the real estate sector. 30 years ago, real estate investment sat at a lowly 200 billion RMB. By 2021, that total had shot up to nearly 15 trillion RMB. As we know, with all real estate booms, debt is an integral component. During that period, private debt as a percent of GDP went from 95% to 213%, an increase of 124%. As we saw in Japan in the 90s and the US in 2008, the surge in real estate-related debt has led to millions of empty buildings and homes, while leaving many businesses and households severely over-leveraged. We estimate there are 90 to 140 million unsold or unoccupied housing units, which is an astonishing number. And to compound that problem, there are another 50 to 80 million housing units that have been pre-sold by folks like Evergrande, but not yet built. That multi-hundred million unit excess means that there is little need for these developers to build more homes, and won't be such a need for many years. That means there will be little, if any, growth in the real estate sector and likely contraction instead. As the Evergrande crisis began to unfold, the real estate bubble began to burst, dropping real estate investment by 25% to a level of 11 trillion RMB in 2023. In the years leading up to the pandemic, China's real GDP average growth was 6.7%. annually. And since the first default of Evergrande in December of 2021, that average is now down to 4.1%, though up a little bit more recently. Last week's news of liquidation may mean the end of Evergrande, but problems are far from over for the real estate sector in China's economy. The troubles of the sector have had a direct impact on employment and consumer spending. Falling home prices chip away at the wealth of households, forcing them to hold on to any excess cash as a safety net, thus lowering demand and forcing China's government to continue to cut interest rates and loosen home buying restrictions, though the problem is so large that the impact of these actions will be limited. According to Rogoff and Yang, real estate activity, including construction spending, reached an incredible 32% of GDP in 2021. That means that other sectors will have to post high growth to pick up the slack, or China's overall GDP growth will continue to soften or worse. One place China has looked to meet their target GDP growth has been increased local government infrastructure spending, which has been financed through alternative lending options such as local government finance vehicles, or LGFVs. But these local governments have now also built way more infrastructure than they need. And according to the IMF, LGFV debt reached an estimated 52% of GDP in 2023, up from 38% of GDP in 2018. So, despite these and other efforts, the economy is still struggling to maintain pre-pandemic growth. So where else can they look? One bright spot has been China's improved trade position. From 2014 to 2019, net exports averaged around 3 trillion RMB, or 3.9% of GDP. And from 2021 to 2023, they have surprisingly grown to an average of 5.5 trillion RMB, or 4.5% of GDP. Issues relating to improved trade will therefore remain a very high priority in China, even in the face of deteriorating relations with the West. That's it for this week. Thanks.